So you want to own a gym franchise, a recognizable brand on the sign, a steady stream of monthly memberships, rows of equipment that basically run themselves once they're installed. It looks like one of the cleanest recurring revenue businesses a franchisee can buy into. Here's the detail that should reframe how you think about this entire industry. A single, large-format, low-cost gym location can serve somewhere between 6,000 and 10,000 members in a building designed to comfortably fit a few hundred people at once. That's not a flaw in the business model. According to people inside the industry, it's the business model. Low utilization, members who pay every month and rarely, if ever, show up, isn't a problem gym owners are trying to solve. It's the exact thing making the math work. By the end of this video, you'll know what it actually costs to open a gym under a major franchise brand, how much of every membership dollar leaves the building before the franchisee ever sees it, who sits electronically between every member's bank account and the gym's, and why the entire industry has been consolidating hard over just the last 2 years. A gym franchise isn't one business. It's 3, all selling the same basic promise of getting in shape. Version 1, the high-volume, low-cost franchise. Think of the $10 to $25 a month membership model, a massive facility footprint, and a business built to serve thousands of members who mostly never show up. This version needs serious scale and serious upfront capital, but the recurring revenue, once it's flowing, is remarkably stable. Version 2, the boutique studio franchise. Smaller footprint, higher price point, classes built around a specific format, and a member base that actually shows up regularly because they're paying a premium, and the group class structure creates accountability. Lower total investment to open, but revenue per location is capped by class size and studio square footage in a way the high-volume model isn't. Version 3, the 24-hour small footprint access club model. Minimal staffing, key fob entry any hour of the day, and a franchise fee structure built around a large number of relatively small, low-overhead locations rather than one big flagship. This version scales through sheer location count more than through any single gym's size. The spread across this industry is enormous. A high-volume, big-box gym franchise can require anywhere from about $1.3 million to over $5 million in total investment, covering real estate, an initial equipment package, build-out, and working capital before opening day. The initial franchise fee alone on a deal like this typically runs $10,000 to $20,000, a small fraction of the total check you'll actually write. A 24-hour Access Club franchise sits at the other end of the spectrum, with a franchise fee in the $20,000 to $40,000 range and total investment often landing between $250,000 and $500,000, since the footprint and staffing needs are so much smaller. A boutique studio franchise typically lands in between, with franchise fees running $50,000 to $60,000 and total investment somewhere around $800,000 to $1.4 million, depending on the market and the build-out. Across almost every major brand, franchisors increasingly prefer multi-unit developers, meaning the real entry ticket for a serious franchisee often isn't one location. It's a commitment to open 5, 10, or more, which can mean $5 million or more in accessible capital before a single agreement gets signed. Here's where the fine print matters. Every major gym franchise charges a royalty on top of the initial fee, calculated as a percentage of what's called the EFT dues draft, the recurring monthly membership charge pulled electronically from every member's card or bank account. Royalties commonly run 6 to 8% of that recurring revenue. On top of the royalty, add a national advertising fund fee, typically another 2 to 3%, and in some franchise systems, a local advertising fund requirement on top of that, sometimes structured as a flat minimum of $60,000 a year or 7% of gross membership revenue, whichever is greater. Added up, and the combined royalty and advertising burden across a typical big-box gym franchise commonly lands at 9% or more of every dollar of recurring membership revenue before a single utility bill, staff paycheck, or Piece of equipment maintenance gets paid. On a location doing close to $2 million a year in membership revenue, a fairly typical figure for an established large-format location, that's well over $180,000 a year, leaving the building automatically every single month by wire before the franchisee touches it. Now for the expense almost nobody budgets for properly at the start, because it doesn't come due for years. Gym equipment wears out under near-constant use, and most franchise systems expect a full equipment refresh roughly every 7 to 10 years. For a large-format location, that refresh alone can run $300,000 to $600,000 or more, a capital expense on the same scale as a meaningful chunk of the original build-out, arriving right around the time the franchisee might otherwise expect the location to finally be running at peak profitability. Franchisees who don't plan and reserve for this refresh cycle from day one often end up financing it under worse terms than their original construction loan, precisely because it tends to land at an awkward point in the location's life cycle, well after the initial excitement and well before the loan is anywhere close to paid off. Here's the part of this business almost no first-time franchisee thinks about until they're already running one. That EFT dues draft, the monthly charge that every royalty calculation in the entire industry is based on, doesn't move directly from a member's bank account into the franchisee's account. It runs through a specialized billing and club management platform built specifically for the fitness industry. One company in particular, ABC Fitness Solutions, processes billing and membership data for more than 9,000 locations and roughly 26 million members, and generates in the neighborhood of $250 million a year doing it. For a huge share of the industry, this single company sits electronically in between every member's card and the gym's bank account, taking a processing and software fee on the transaction before the franchisor's royalty percentage is even calculated on top of what's left. It's a layer most new franchisees don't fully register when they read 7% royalty in a disclosure document, because the actual number that royalty gets calculated against has already had a fee taken out of it upstream. This billing relationship isn't optional in most systems. It's often built directly into the franchise agreement, meaning the franchisee doesn't get to shop around for a cheaper way to collect the very revenue the entire business depends on. And this is happening at a moment of real structural change in the industry. In 2024, Orange Theory Fitness and Self-Esteem Brands, the parent company of Anytime Fitness, merged to form a new combined company called Purpose Brands, instantly creating a fitness empire with more than 7,000 locations spanning both the boutique and 24-hour access club models. Private equity activity across fitness franchising has intensified right alongside it, treating the recurring revenue sticky membership model as a genuinely attractive asset class in its own right, separate from whether any individual gym happens to be a great place to work out. For an individual franchisee, this consolidation wave cuts two ways. A bigger parent company can mean more marketing muscle, more technology investment, and more real estate leverage when it's time to negotiate a lease. It can also mean less individual bargaining power, a billing and royalty relationship increasingly set by a company managing thousands of locations at once, and a franchise system where major structural decisions get made at a scale far removed from any single gym floor. Scenario 1. A franchisee commits to the high-volume, low-cost model with the capital to open several locations at once, securing better real estate terms and equipment pricing through scale. The franchisee budgets from day one for the equipment refresh cycle, setting aside a fixed percentage of monthly revenue into a dedicated reserve rather than treating it as a future surprise. Membership volume builds toward the 6,000 to 10,000 member range per location. The low utilization model works exactly as designed, and at a 30 to 40% EBITDA margin on close to $2 million in annual revenue per location, the economics across a multi-unit portfolio become genuinely compelling, even after royalties, advertising fees, and billing costs are accounted for. Scenario 2. A franchisee opens a single location at the lower end of their capital range, stretching to meet the multi-unit development expectations of the brand without the reserve capital to match. Membership growth is real but slower than projected, and 9% of recurring revenue leaving automatically every month for royalties and advertising fees puts real pressure on thin early-stage margins. When the equipment refresh comes due in year 8, there's no dedicated reserve to draw from, forcing a refinance at a worse rate than the original construction loan. The brand, the location, and the membership base all look identical to Scenario 1's early years. The difference is entirely about capital planning for costs that don't arrive until years after the ribbon cutting. So the next time someone describes a gym franchise as one of the simplest recurring revenue businesses a person can buy into, the recurring revenue part is genuinely true. But underneath that steady monthly draft sits a royalty calculated on money that's already passed through someone else's billing platform, an equipment bill that doesn't come due for years, and an industry consolidating into fewer, larger parent companies at a rapid pace. The workout was never really the product. The EFT draft, who takes a cut of it before you do, and whether you planned for the bill that arrives in year 8, that's the actual business.